Intro to Accounting, Mr. Roberts here, and today we're going to continue analyzing transactions that are going to affect our owner's equity account. And I'm going to be upfront with you. Today is one of those days that people get a little bit frustrated and they go, What do you mean? Wait, that doesn't make sense. This is breaking some of the rules that we've been following. And it's kind of true in a way, but we're going to be introduced to some new accounts, and we're going to look at what their normal balance is when it comes to debit and credit. And this is so important that you understand these two accounts specifically, because they are the ones that over the last couple of years when I've been teaching this class, people get confused on, okay? And I want to tell you that right now so we can kind of just get right into it and start looking at these accounts that are going to affect our owner's equity. So what I'd like you to do before anything else is take out this sheet. Now, you remember before when I said this sheet is going to be your best friend for this chapter. It really is. If you take a look at what we've already gone through, you can see that we have assets here, and it shows us what the normal balance is, which is the debit balance, right? DR is debit. It's a Latin word, remember? So assets, debit here, okay? The debit side is the normal balance. That's how we increase assets. And then you can see all the different assets that we had here. Cash, supplies, inventory we won't really use, but accounts receivable, anything that's prepaid, those are all assets. So once you start looking at this and we go further into the units, you're like, oh yeah, I've seen all those assets. I know that assets increase on the debit side, and it's going to decrease on the credit side. And we go over to the other side of the accounting equation, and we have liabilities. And the only liability we've really used is account payable. And the liabilities are on the right-hand side of the accounting equation, so it is going to increase on the right-hand side, the credit side. If we want to decrease liabilities, we need to debit it. And then we have our owner's equity. And our owner's equity has our capital account here, right? And capital, being on the right-hand side of the equation, is going to increase on the right side, the credit side, and decrease on the debit side. This should all be a recap or like a review for you because we've been going over it for a little bit. Now, there's 4 different events, and you can see this here, that's going to change our owner's equity. 4 different things. The first one that we have is when the owner is going to invest money in the business. Now, how does this increase it? Well, remember, the owner's taking money and they're putting it into the company, and now they have more equity in the business, more claim to the business's assets, right? If you're running a business and you put another $1,000 in it, you would want to claim to that $1,000. So that makes sense. The next thing is if we earn revenue. So if you own this business and you make, let's say, $10,000 in sales, you have a claim to those $10,000 in sales, right? So anytime that you earn revenue, you have a bigger claim in the assets of the business, because essentially there's more assets in the business. Anytime we earn revenue, it means that we've increased cash or we've increased our accounts receivable, which is going to turn into cash. Now the next one, and these are the 2 that are going to get tricky, but you can understand where they're coming from. The next one is incur expenses. So if you incurred a bunch of expenses, you had to pay for a bunch of things, in the business needs to buy a bunch of things so they can later on earn revenue. Well, what that's really doing is you're using assets to purchase expenses most of the time. So if assets come out of the building because you're purchasing expenses, what's going to happen is the owner is going to have less equity in that business, and it's going to go down. The last one is going to be owner draws. So now the owner comes around and he says, hey, I really think the business is doing well. I'm going to take some of that money out and I'm going to go on vacation, right? And he takes out $1,000. He or she takes out $1,000. Well, if that's the case, The owner has money in his own personal account now, but he took out $1,000 from the business, meaning there's less assets in the business, less assets he has a claim to, so the owner's equity goes down. So we should have a pretty decent understanding of these things. And when an owner invests money in the company, we know that capital is going to increase, okay? And that's pretty straightforward. We've been doing that a couple times. If we earn revenue, we're going to start recording that in a revenue account, okay, right here. Now, what normal balance, this is what you need to remember. What normal balance does a revenue have? It has a normal credit balance, okay? So revenue has a normal credit balance. If we want to increase revenue, we are going to credit that account. And then it's going to increase our owner's equity, okay? It's going to increase it on the credit side as well. Now, these next two are the tricky ones, okay? Here they are. Expenses, even though it's going to affect something on the right-hand side of the accounting equation, expenses are going to have a normal debit balance, okay? Now, it might be a little bit weird, but the way that we need to look at this is owner's equity over here has, like, you can see it even says expanded equation continued. So we have like owner's equity up here, and then we have the sub accounts that are below it, right? And expenses, if owner's equity needs to decrease, well, we need to debit our owner's equity, right? That's how it goes down. That capital or equity goes down with a debit. So in order to make it go down, what we're going to have to do is, for an account like expenses, we need to increase the expense account for our owner's equity to go down. This is by far the hardest thing that students have right here, is remembering that this expense account has a normal debit balance. And remember, this can be rent, wages, insurance. If we use supplies, okay, I think we can get into that later, so don't worry about that yet. But rent, wages, insurance, paid a bill, these are all expenses. And you've recorded expenses before, but now it's changing a little bit because we are going to record it under the expense account. And if you had to think about this for a second, if you had to pay a bill and we have the expense account records how many expenses you have, okay? So anytime that we have an expense, right, we're like adding to the total. If we have an expense for a communication bill, we have to increase expenses. If we have an expense for rent, we need to increase the expenses again because it's more bills that are coming in, okay? So when it comes to expenses, the normal balance is the debit side. Write it down somewhere, put it on your notes. Hardest thing that it is for students to remember. Draws is also has a normal debit balance, and it decreases your equity. So now we're going to record underneath the draw account. And this withdraws, same thing when you're recording it before, but it has a normal debit balance. What makes this so hard is we look at this sheet and everybody kind of goes, okay, everything on the left, just like we were talking about, everything on the left of the accounting equation, you debit it to increase it. Everything on the right, you credit it to increase it. Well, expenses and draws, when we look at it, we kind of assume it's on the right-hand side. And it is, technically. But they don't follow that same rule because we need to decrease our equity accounts, which would be capital here, and to decrease it, we need to debit it. In order to decrease it, that means that we'd have to increase expense and draws, and to do that, we need to debit it. So it's like we need to do one thing to expenses and draws to affect our capital. A little bit confusing, but I'm sure with practice and repetition and being intentional with remembering those, it's going to get a little bit easier. So first 10 minutes of this lecture is just dedicated to this because I want you guys to remember what the normal balances are on this sheet or as we go through this. So make sure that you're looking at it. Next, let's go through some of these transactions here. And they're not transactions you haven't seen, okay? These are all transactions you've seen. It's just how do we record the change? And we're still asking ourselves these 4 questions. They kind of go in and they give you some definitions for things that we've already been talking about. So, the big thing that we want to talk about here is we're including a new account, as in sales. So we're starting to record things under where they actually occurred. So now we have this account called sales because we're not just going to list everything under owner's capital, right? We're not going to say every sale that we have, every expense, every withdraw. We can't record that all underneath capital and just, it'll be an absolute mess. So now we're getting to the point where we're writing things down under specific accounts. So what happens when we receive cash from sales? Well, cash is going to increase. And what we have done in the past is we go, oh, okay, that's sales. What's that going to affect? Owner's equity. Okay, that's absolutely true. It still is going to affect owner's equity, but now we're going to affect owner's equity through the sales account. So how do we increase sales? Because that's what we've done here, right? And honestly, are we ever going to decrease sales? Like, would we? Maybe if we have a return on something, but that's not going to happen in this chapter. So we're always going to be increasing sales on the credit side. So here we received that cash. So we debit cash. And then how do we increase sales? We must credit sales as well. So which accounts are affected? Cash and sales. How is each account classified? Cash is an asset. Sales is a revenue. Remember, sales is a revenue that will affect our owner's equity. How are they changed? Assets increase, owner's equity will increase, and then assets on the debit side, and then owner's equity will increase on the credit side. Just like this, okay? And as you're doing problems, and you're like, oh, I don't remember, come back to these slides. They tell you exactly what's going to happen here, and I'm fine with you looking at it for a little bit. So we sold services on account. First thing, is cash involved here at all? No. Okay, that's one of the things that people tend to get wrong. Sold services on account. That means you you did something for somebody. They haven't paid you in cash yet, but they said they're going to pay you. So you can see here it says amounts to be received in the future due to the sales of goods is accounts receivable. We've already looked at that before, but now they're giving you the definition again because we are recording it underneath accounts receivable. So what are the accounts that are affected? Accounts receivable and sales. Remember, an accounts receivable, when we sold services on accounts and they're going to pay us later, it's still considered a revenue. Okay, still considered a revenue. So accounts receivable and sales. What's accounts receivable? It's an asset. What's a sale? It's a revenue that's going to affect our owner's equity. Is accounts receivable going to go up or down? Well, accounts receivable will go up because that company now owes us more money. Sales, on the other hand, is also going to go up, okay? And how does sales increase? It increases on the credit side. So there we go. That's what we're going to do. We're going to debit our accounts receivable, and we're going to credit our sales. Okay, now here's a slide that might rack your brain a little bit, but it's okay. It says we paid cash for communication bill for cell phone and internet service. Now, this is very, very specific, right? At this point, the expense account is used for all payments of cell phone charges, right? Okay, we can highlight that. And when we look at this, we can probably say, okay, we know that cash will be affected, and now we're going to record it underneath an expense. We know in the past that owner's equity is going to be affected, and it will be, but we affect it through the expense account. Now here it says communication expense. Well, why is that important? Well, it's important because it's kind of specific, right? And here we're recording those expenses in a way where we can tell where our money went. If you're running your own business, you wouldn't want everything just under expenses because you want to track where it is, right? I want to know how much the phone bill costs. I want to know how much salaries expense costs, how much I'm paying my people. So there'll be multiple expense accounts. We just got to keep our eyes open and look for what specifically. So we go through the questions: which accounts are affected, communication expense, and cash. How are they each classified? Communication is an expense account that affects owner's equity. Cash is an asset. How are these going to change? Owner's equity decreases, okay, from an increase in expenses because expenses brings down our owner's equity. Assets will decrease. So how do we actually do this? Let's just read their explanation first and then go up and take a look. Owner's equity accounts decrease on the debit side. So an increase in expenses decreases our owner's equity. Expense accounts have normal debit balances. Therefore, we debit the expense account, so communication expense, and assets decrease on the credit side. So you credit the asset account cash. So here, what we're really looking at is communications expense has a normal debit balance, and we need to increase that expense because we now have more of that expense. Even if you pay it, think of it this way, like we need to still record it for the entire month or for the entire year because we want to see where that money's going. So we still write down salaries expense, okay? It's like, this is more so a record, right? Our owner's equity will go down as well. But what we really want to look at is this communications expense. All right, so that's the second transaction. Next, we received cash on account. This is a very similar one to the one that we've done before, okay? No real tricks here. We look at it, what are the accounts? Cash and accounts receivable. They're both assets. Cash is going to increase. Cash increases on the debit side, and accounts receivable is going to go down because remember, the people that owe us money are going to pay us. So credit or accounts receivable will decrease and assets decrease on the credit side. All right, and now we have our drawing account, okay? So this is what we're going to call it when the owner wants to take money out of the account. We're going to call it the drawing account. So the name of the owner followed by drawing. So here, if you look at it, Michael Delgado withdrew equity in the form of cash, which means he's taking out cash, right? And remember, when our owner withdraws money, it's going to decrease our owner's equity. So the way that we decrease owner's equity is by looking at that drawing account and increasing it. Because remember, drawing is going to show us how much money overall our owner has taken out. So at the end of the month, if our owner took out money 3 times, we would see that there's 3 different transactions that have taken place here. So every time it happens, we need to record it. So what do we need to record here? We need to record that Michael Delgado's drawing increased. What's the normal balance on a drawing account? It's going to be the debit side. So we debit Michael Delgado's drawing. Okay, we debit Michael Delgado's drawing to increase it, and then we decrease the cash. So expenses and drawings are the two kind of really, I would say, difficult things to kind of look at. You can read over this page on your own about pyramid schemes. They do talk about an account that uses their skills plus investigative skills to uncover fraudulent business activity, and that's called a forensic accountant, which is a pretty sweet job. So forensic accountant, you're kind of being a detective and looking in to see if somebody maybe committed fraud. So that's the end of our lesson here. You can always go in here and answer some of the questions. It's pretty helpful, okay? And just test your knowledge a little bit. You know, as you continue doing some of the problems, which we're about to do in a second, you know, it's also important to be able to come in here and say, okay, what two accounts are affected when a business sells services on account? And hopefully you can say sales and accounts receivable, and that's going to pop up here because you've taken that test now. You've taken chapter 1 test. You want to be able to make sure that you're not just doing the problem. You can also think through the problems and the reason why behind it, what accounts are affected, because you'll need to do that with true or false and some of the concept questions that are there. So let's close that. I wonder what's in the terms review. Let's see. Let's see what's in this terms review. Because there was only 2 or 3, different ones here. So, amounts to be received in the future due to the sale of goods or services. Now remember, always put yourself in the position of the business, okay? So, amounts to be received in the future due to sales of goods or services. Well, if my business sells something and somebody's going to pay me back later, that's an accounts receivable. A list of accounts used by a business, that's a chart of accounts. Amount to be paid in the future for goods or services that were already required, like buying supplies on account. That's going to create an accounts payable. Let's submit that for grading. Hey, 100%. Okay. Pretty straightforward. Audit your understanding won't be there when you guys open it. So I do have 2 different problems here for the application because I really want you guys to practice this, okay? I'll do the working papers with you, but then there are 2 different problems. Keep that in mind because I want you guys to practice. One of the other things to kind of mention, this score here does not matter if one problem's a 20 and another one's a 1, okay? It's all based on percentage. So if you're seeing those and you're like freaking out, do not, okay? Alrighty. So now Jensen Cleaning Services uses the list of accounts, prepare 2 T accounts for each transaction on each T account. Select the account title of one of the accounts affected by the transaction and then enter the debit or credit amount. So the exact same thing that we did last time, okay? And remember, use this sheet if you need to. All right, let's jump in. Here's our transactions. So I sold services on account to Johannes Eriksson. All right, let's also open up our book, okay? Because I don't want you guys guessing. I want you guys knowing what's happening here. So just so you know, here's our table of contents. I want you guys to look in the book and refer to it until you remember it. So sold services on account. I click sold services on account, and now I have the entire thing, right? So remember, we always list the debited account first. When we sold services on account, that's going to create an accounts receivable. And we're going to increase that because we sold it on account. So to increase an asset, we're going to increase it on the debit side. Next, we sold services on account. What is the other account that's going to be affected? If we look at this drop down or over here, we can see that sales is going to be affected. And you can see that John Jensen's capital is also on here. And you might be tempted to be like, oh, well, it's going to affect capital. I mean, technically, it is going to affect capital eventually. I don't know if that's our business, Jensen Cleaning. Yeah, so It will, but it's going to be recorded underneath sales. Remember, because we can't just list everything under capital. We'll have a giant mess at the end of the month because then you'd be listing expenses. You list all 4 of those different things that affect capital under one account, and it'd just be a giant mess. So sales here, and sales has a normal credit balance. So we're going to credit this amount. Guys, see how there's always a debit, a credit, right? We're always balanced too. Okay, 13. Received cash from sales. Go back 1. We still have this, okay? I want you guys to refer to this. It's not cheating or anything. I want you to look at it and remember it. Put in the work now so then you remember it later. So we received cash from sales. What's the first thing that's going to be affected when we look at that? We received cash, right? So we know that cash is going to be our first account. We know cash is an asset, and to increase an asset, we must debit it. So I can just put that in right away. And this is from sales. So it's going to be our sales account, and sales has a normal credit balance. So sales is going to increase by $260. 14, paid cash for a telephone bill. Anytime we have a bill like this, it's going to be an expense. So we paid cash for a telephone bill. Just looking at that, okay? Like, we can ask ourselves the 4 questions. What's going to be accounted? Cash and probably a communication expense. What are they? It's an asset and it's an expense. It's going to affect our owner's equity. We can look at all that, but what do you know before anything else? Well, I know cash is going to be affected and cash is going down, right? So if that cash, that asset has to go down, it must be credited. So I know right away that I'm not going to list cash in this first section, right? It's going to be something else. I'm going to put cash down here because I know cash goes down, and to decrease an asset is going to be credited. So I'm just going to go like this. I'm going to put $54 in here because I'm pretty confident in that. Now, what's the other thing? It was for a telephone bill. So you can see here that they have an accounts payable, drawing, rent expense, and utilities expense. Utilities is like power, phone, any of that stuff. So it's going to be a utilities expense. And when we have an expense, we look at this, and to increase an expense, we must debit it, okay? So we're going to debit this utilities expense. And I know what some of you guys are going to do. You're going to put cash down here, and you're going to go, expense has to be a debit. It just has to, right? Like the other one's a credit. Just make sure that you're starting to remember that expense has a normal debit balance, okay? Don't just look at it and game the worksheet, because you want to understand it a little bit better than just gaming the worksheet. 16, we received cash on account from Johannes Eriksson. So now we're receiving cash on account. Is that a revenue? No, it's not, right? It is not. And it's not a sale either, okay? It's not a sale or a revenue. Usually we use those pretty interchangeably. Why? Well, because on the 11th, look at this. We sold service on account to Johannes Eriksson, and we recorded that as a sale. Now he's just paying us that money. If we recorded it as a sale again, we'd be recording that as a sale twice, and that wouldn't be accurate, right? So when we look at this, received cash on account. So what's the first thing that's going to happen? We have cash and accounts receivable. And I know that cash is going to have to increase, so it's going to be debited first. Okay, so cash is going to be $125. And then the other account that's affected is accounts receivable. And accounts receivable goes down. How do we decrease an asset? We credit it. So now the 19th, okay? Paid cash to owner for a withdrawal of equity. Okay, so the owner took money out. Let's go to the book. Paid cash to owner for personal use. We are now looking at the drawing account. Okay, so we paid cash to the owner for a withdrawal of equity at $200. We go down here, and I know that cash and drawing is going to be affected. We always have to list the debit first. So let's put in John Jensen drawing, and then cash will be the other account that's affected. And John Jensen's drawing, to increase this account, we need to debit it. So $350. And cash will go down because he, oh, did I put 350 because that's what the problem did? Yeah, it's $200. Would have got it wrong. Got to check your work. Okay, and then cash will go down because the owner took that money out of the business. And this drawing account is going to affect capital, but we don't record it, okay? We don't record now, like we don't do another thing and have it affect capital, right? We want to make sure that we're recording it specifically under what is happening here. That's what this chapter is about, along with debits and credits. So I'm just going to look through this real quick, make sure there's one on each side. Let's save and continue. So then they have the on your own, which I will let you guys do because we just went through all the transactions that we covered. So I'm done. Let's grade this assignment. Hey, 20 out of 20 up here, okay? So that is the working papers. Let me just pull this up real quick. These will be randomized. So it's the exact same thing. Actually, this one probably won't be randomized. I don't know. We'll see. I'll leave this. You only have to complete it once, okay? And I'd probably do the static first. So if you go into the static problem, what is it? Same exact stuff, okay? Nothing new, nothing different, just more practice. So there we go. That is 2-3. So this video is 31 minutes, a little bit longer, but this is something that you really want to understand as we continue forward because we're going to be using revenues or sales, expenses, and withdrawals or drawings throughout the rest of this trimester. So if you have any questions on it, please let me know. Use your book and the handouts as a reference until you really understand it. So if you have any questions, let me know. All right, talk to you soon.